This is the GCSE Business Studies revision on the finance section. We started off the finance section by looking at sources of finance, and that means the places a business can go to get its money. Now, sources of finance can be internal or they can be external. And internal sources of finance usually include the owner's own money. So we would call it owner's funds. So they might put their own money into the business. They could be reinvested profits. So profit left over from last year and put back into the business. Sometimes that's also called retained profits. Could be either in the exam. And another way of getting money internally is by selling assets. So that's when a business might sell off any machinery that it's not using, any land that it perhaps hasn't got anything on, any vehicles that are a bit redundant and they're not using them. They're the kind of assets that they might sell to make some money. External sources of finance then might be bank loans. So we're talking anywhere outside the business that could lend or give the business money. So bank loans, which would also include overdrafts, it's a type of bank loan, we'll talk more about later. Selling shares. Now it can only sell shares if it's a LTD or a PLC. If it is a sole trader or a partnership, an option would be to take on a new partner. Hire purchase is another option, and this is where a business buys an asset but pays for it almost in instalments, really. So pays monthly, and then when they've finished paying it off, they own the asset at the end of that. Leasing is another option, which is just like renting, perhaps a piece of equipment or a building. Government grants. Now, grants are sums of money that don't have to be paid back, but they're only given for under certain conditions. So you have to employ a certain number of people or have to be environmentally friendly in some way, and you might be able to get a grant from the government. Trade credit is another. And that is where you buy materials or equipment from a supplier, but you don't have to pay for it until a month later. And the final external source of finance is venture capital. And this is where you invite an investor to buy some shares in the business. And it's very similar to the dragons on Dragon's Den. They're investors, and they will provide the business with some money in exchange for some shares, some ownership of that business. So they become shareholders in the business. Usually venture capitalists will take a risk. So if it's a risk, they'll invest in a business, help the business to improve and make some profit, and then when they've become profitable, they'll sell their shares in the business for more than they paid. So they make some money that way. You need to know the advantages and the disadvantages of different sources of finance. So, for example, all of the internal sources of finance come from within the business, so they don't need to be paid back. External finance, a lot of them do need to be paid back, and quite often interest is charged. So you have to, for example, if you take out a bank loan, you have to pay back your bank loan plus extra for interest. The disadvantages of internal sources of finance is that it's quite limited. You might not have any assets that you can sell off. The owner might not have any money that they can put into the business, so you're quite limited. It's really important that businesses choose the right source of finance. And when you're answering questions on this in your exam, you need to have a look at the type of business that you're talking about. Now, there are a few factors that a business needs to consider. So first of all, the availability of finance. So they will look at the type of business, the size of the business, whether they are in the right location to get a grant. So the availability for that specific business. Could they get it from a bank? Would they be eligible for a government grant? Secondly, they have to consider the interest charged. So as we said earlier, the business may borrow money from a bank. They have to pay back that money, plus they have to pay interest back on the top of that. The business also needs to consider the time they have for repayment. So do they want to pay it back in the short term or the long term? If it's short term, they might go for an overdraft, and if it's long term, they might look for something like a long-term loan. The business also would need to consider the amount of money they need. So, like we said earlier, if they're looking for a large amount of money, an external source of finance may be more appropriate. The purpose is quite important. So what do they need the money for? Do they need to spend a lot on buying new machinery or new vehicles, or is it just for day-to-day expenses? And another consideration is the type of liability that the business has. So is it limited or is it unlimited? If they have unlimited liability, they may not borrow as much money because they would be personally responsible for paying that money back. A business plan is really important for a business. It sets out some of the main priorities, aims and objectives of the business, and it's also really useful. It's used when a business wants to apply to a bank or another institution for a loan. A business plan is made up of a few key elements. So first of all, it will contain the business name and the registered address. It will contain the ownership structure of the business. So is it a sole trader or a partnership? Is it a private or public limited company? Who are the owners? Who are the managing directors? It will include information about the product or the service. And then it will include, and probably the most important part, is current and forecast financial information. Now we'll go on and look at some of that information shortly. But it will include a cash flow forecast, it will include a profit and loss account, and it will include a balance sheet. And one last thing that may be included in a business plan is any market research that the business has carried out. So where it's gone and found information from potential customers. You need to think about why the bank would want to see this sort of information when it's deciding whether or not to give the business a loan. Cash is really important to a business. It allows the business to pay its day-to-day expenses and to pay its staff, pay its suppliers, and all of the other costs that it will incur. A cash flow is the money moving into and out of the business. We talk about cash flow in terms of inflows and outflows. Now, inflow is all of the money that moves into a business over a period of time, and it will include sales revenue. And don't forget in your exam, sales revenue may also be called turnover. Outflows is where money moves out of the business, and usually we call it expenses. So it includes anything the business spends money on. And don't forget, we're talking about a forecast. A business will normally prepare a cash flow forecast for maybe 6 months, maybe a year, but it's a prediction or an estimate of money that will be moving in and out of the business over that period of time. So it's important to realise that it might not be accurate because it's just a prediction. Now, when we talk about expenditure and typical business costs, we're talking about things that a business spends its money on every day, every week, every month. So stock or materials, rent, maybe a mortgage if they've bought their property, business rates, which are like taxes for business, wages, any bills it's got to pay, repayments on loans, anything like that that a business spends its money on comes under that outflows category or expenses. So this is an example of a cash flow forecast. At the top you've got inflows, and this shows all the money coming into the business, usually through sales revenue, and sometimes it's called turnover or receipts. Then you've got your total outflows, which is money going out of the business, your business expenses. Sometimes this is called payments. Your net cash flow shows what has happened during the month, and it shows the total of inflows minus outflows. You need to know the formula for this. You might have to calculate it in your exam. You might want to make a note of this. Net cash flow equals total inflows minus total outflow. So you can see in October the inflows were 6,000 and the outflows were 6,500. Remember that you're taking away the outflows from inflows, so your net cash flow is minus £500. Your opening bank balance is the amount of money in the bank at the start of the month. The opening balance will always be the same as the closing balance from the previous month, because what you end October on, you will start November on, for example. And your closing balance is the amount of money in the bank account at the end of the month. The closing bank balance is calculated by adding the net cash flow to the opening balance for that month. So if you look at November, 1,500 plus minus 500, be careful with minus numbers, gives you a closing bank balance of £1,000. Pause the video now and see if you can fill in the grey shaded squares. Check your answers against the ones on the screen. So the formula that you need to know net cash flow is calculated by total inflows minus total outflows. Opening balance is your closing balance from the previous month, and then to work out your closing balance, you do your net cash flow plus your opening balance. Now, you won't be given these formulas in your exam, so you need to know how to work them out. You might be asked to fill in some blanks on a cash flow forecast. A common question in the GCSE exam is how could this business improve their cash flow? So there are two ways of improving cash flow. The first is by increasing revenue. And as you know, revenue is the money coming into the business. And the second is to decrease costs. Now, when you're writing your exam answers and you have a question on improving cash flow. And you're going to say, well, they could increase their revenue by using the marketing mix. And think back to marketing mix, which is the 4 Ps. Okay, and they could use the marketing mix to help them increase sales. You might also say your second argument might be to improve their cash flow, they could decrease their costs. However, and you might say to decrease their costs, they could get cheaper supplies. However, you need to say cheaper supplies could lead to issues with quality. So cheaper supplies might mean poorer quality products are made. And if you're going to change your marketing mix to increase your revenue, this may also increase your costs. So while it might increase your inflows, it might also affect your outflows and not necessarily improve your cash flow. An A-grade answer would include all of those points, and that's something that you should be trying to put in your extended answers. One of the most important financial documents for a business is the profit and loss account, and it's important for 3 main reasons. Firstly, it'll be included in the business plan. So when the business is trying to take out a bank loan, the bank will want to see a profit and loss account to make sure they can pay back their loan. Secondly, it's important for a business to be able to calculate the amount of tax it needs to pay to the government. And thirdly, it shows how well the business is doing. So if you're a shareholder and you've got shares in a business, you want to see how much profit the business is making to know how much you will get back from having shares in that business. Now, profit and loss account shows 2 different types of profit. It shows gross profit and it also shows net profit. Now, the difference between those is that gross profit is the money the business makes directly from selling its product. So you need to know the formula. So gross profit is sales revenue, so all the money the business makes from selling its products, minus the cost of sales, so whatever it costs them to make those products. Once you've worked out your gross profit, you can work out your net profit, and the formula for that is gross profit, so the money you've made from selling your products and paying those expenses, minus all of the other business expenses. And we talked a bit about those earlier, so all of the other things that it spends its money on, like its rent, for example. The profit and loss account is important. As I mentioned earlier on, shareholders of the business will want to see the profit and loss account, but so will other stakeholders in the business, such as the government. They want to make sure the business is paying the right amount of tax, so they need to check how much profit the business is making. The owners of the business, because profit is sometimes reinvested, so they need to make sure that reinvested profit can be used in the future, usually to help a business grow. This is an example of a profit and loss account. In your exam, it might not be this detailed. You might just get an extract of a profit and loss account. At the top will always be sales revenue, which is the money made from selling your product. It could also be called turnover. The cost of making the product is known as the cost of sales, and it includes things like the materials used to make the actual products. You take your cost of sales away from your sales revenue to give you gross profit, which is the profit made from actually selling the products. Next, you have to work out total expenses, and these are other business costs that still have to be paid but not directly associated with production. When you take your business expenses away from your gross profit, you get net profit, which shows the overall profit for the business. Pause the video and see if you can fill in the grey squares. Check your answers against the ones on the screen. For your exam, you might be asked to calculate the profit percentage, or a percentage profit. Now this shows profit as a percentage of sales revenue. And it's used as a measure of success of a business. So if they've got a high profit percentage, it could be said that they are a successful business. There are two formulas that you need to know. So first of all, the gross profit percentage is gross profit divided by sales revenue times 100, because it's a percent. And don't forget to show a percent sign after your answer. The net profit percentage, very similar. I'm sure you've guessed. It is net profit. Over sales revenue. Times 100. The final financial document that we need to look at is balance sheets. Balance sheets are used to measure the value of the business. And when you're watching the news and you're listening to people telling you how much a business is worth, this is where that information comes from. So it shows the value of the business. Now, in order to look at a balance sheet, there are two really important terms that you need to know: assets and liabilities. And we'll talk more about them in just a sec. And also, you need to think about the timing of things. So, are we talking short term? Or are we looking more in the long term? When we're talking about short term or current assets and liabilities, we're talking less than 1 year. So are these things going to change in less than 1 year? If so, they're short term and we call them current. If they won't change in the short term and they will last more than 1 year, we say they are long term liabilities or fixed assets. So assets are items that the business owns. Assets add value to the business, and they can be fixed. As we said, fixed assets are long term, or they could be current, which is short term, so they will change fairly quickly. Fixed assets include land and any buildings the business owns. It'll also include any machinery owned by the business, and also vehicles, any vans, delivery lorries, that kind of thing. Now, all of these things are long term. They last for a long time. They're not likely to change within a year, within a 12-month period. Current assets, however, short-term assets, are things like cash. It adds value to the business, but will be spent quite quickly, in less than a year. Stock. A business would hope to sell its stock in less than a year. And debtors. Debtors are people who owe you money, usually your customers. Not all businesses have debtors, But businesses who do have debtors, usually we're talking about customers who owe the business money. Liabilities can also be short-term or long-term. So when we're talking about current liabilities, we're talking about short-term debts. Liabilities is money that the business owes to other people. It's debts. So current liabilities, short-term debts, will include any short-term loans. So if they've borrowed money from the bank that has to be paid back in a year, it's a current liability. Overdrafts. Now, an overdraft is where the bank allows you to borrow more money than you've got in your account for a short period of time, and it has to be paid back with interest. Creditors are current liabilities, and these are people the business owes money to. So usually it's suppliers. Long-term liabilities include debts that the business have which last more than a year, and usually it's a long-term loan. Some of the key calculations that you'll need to do balance sheets are net current assets, and you calculate this by doing current assets minus current liabilities. This is also called working capital, and we'll talk more about that later. You also need to know how to calculate net assets. Now, this is the value that shows the wealth of the company, so it shows how much the company is worth. And this is net current assets minus any long-term liabilities. That has to balance with capital employed. Which is right at the bottom of your balance sheet. Let's have a look at a balance sheet. This is what a balance sheet looks like, and again, in the exam it might not be this detailed. You're more likely to just get some extracts from a balance sheet. So at the top you have your fixed assets, followed by your current assets and current liabilities, and then you'll have to probably work out net current assets, and that is your total current assets minus your total current liabilities. You then have total net assets underneath. You have to add your fixed assets and your net current assets together and take away your long-term liabilities, so any long-term loans that you have. At the bottom, you have got what is known as total capital employed, and you just add up everything underneath the total net assets to get that figure. Now, it's called a balance sheet because the total net assets and the total capital employed always balance, and you'll see on this one they're exactly the same figure. That's how you know if you've done it right. They will balance. Pause the video and see if you can fill in the grey shaded squares. Check your answers against those on the screen. Now, as mentioned earlier, working capital is another way of saying net current assets. So it is your current assets minus your current liabilities. And it is money, it's called working capital because it's money that is available for use on a day-to-day basis. So for a business to be able to cover its everyday expenses. It's really important to a business to be able to pay its bills, pay its suppliers and things like that. Otherwise, it will start to have cash flow problems. The final part of the finance section is all about business performance. How do we know if a business is performing well? First of all, we need to look at the performance over time. So how is it performing compared to last year? Is it making more or less profit than last year? It's all very well saying, oh, the business has made £50,000 profit this year. That's brilliant. But what if it made £100,000 profit last year? Perhaps that shows that it's not doing quite so well this year. A business will also look at its performance against its targets. Has it met its aims and objectives? Has it achieved what it set out to achieve? If not, perhaps it hasn't performed as well as it could. Finally, managers and owners will look at a business's performance against other businesses, especially similar businesses. So how is this business doing in comparison to its competitors? For example, is Tesco making more profit than all of the other supermarkets? If not, why not? Why are people going to Morrison's or Asda or Sainsbury's instead? To be able to talk about whether a business is performing well or not, you have to look at those three things. Performance over time, so compared to last year or the year before. Performance against targets, is it meeting its goals? And performance against other businesses. So is it doing better than other similar businesses in the industry? And for the finance section of the course, that is it. And again, good luck in your exam.